Hi there. Welcome to the episode. In today's program, we're going to talk about how your IRA and or other retirement account activity can potentially impact your tax brackets. Today's conversation is very timely because you'll learn that the tax brackets from 2023 to 2024 are being adjusted for inflation. I'll show you exactly what I mean by that in just a few moments. I'll also share with you, for those of you that aren't familiar with the federal income tax brackets and how they work, how the calculation is done in order to determine what your effective tax rate is compared to your marginal tax rate. So you hear people say, that jumped me into a higher tax bracket. Well, that's not always a negative. So although some of your IRA or other retirement account activities can have an impact on your tax bracket, that doesn't always mean that it's a negative. In fact, you're going to see that it could potentially be a positive. Additionally, it's important to understand that under the Tax Cuts and Jobs Act that went into effect in 2018, there were certain provisions that made adjustments to the federal income tax brackets. And so you'll see that those adjustments, the percentages for most people went down. However, in 2025, at the end of 2025, those provisions under that legislation are going to sunset, which means many Americans are going to find they're going to pay more in taxes. Their tax bracket on a percentage basis is going to go up. So we're going to discuss all of that in this episode. Let's start with the IRA activities or retirement account activities that you want to consider in terms of impacting your tax bracket. And I'll mention, because of the timeliness of this discussion, this would be a great time for you to sit down with your CPA or your tax professional and start discussing tactics and strategies around retirement planning, and make sure you do that well in advance, because again, there's going to be some of these provisions that are going to sunset at the end of 2025. Okay, let's get started with the IRA activities. So first, which is an obvious one, is contributions. So when you contribute to a pre-tax IRA or other retirement account, in most cases, you get a tax deduction. So that tax deduction would lower your tax basis. So what are pre-tax accounts? You want to think of a traditional IRA, a 401k. Maybe you don't have a 401k at work, but you have a 403b or a 457 deferred compensation plan, or maybe a TSP, thrift savings plan, if you're a federal government employee. So there are different types of workplace retirement accounts that allow you to contribute on a pre-tax basis. So when you make those contributions, that amount that you contribute is deducted from your taxable income, thus lowering your taxable income, which could potentially put you into a lower tax bracket. Now, those accounts grow tax deferred, which means eventually when you take money out, you have to pay taxes. The analogy we always use in the industry is you either pay taxes on the seed or you pay taxes on the crop. So with these pre-tax accounts, traditional IRAs, 401ks, SEP IRAs, simple IRAs, you get the deduction now, but eventually when you take the money out after the age of 59 and a half, that amount that you take out is added to your ordinary income, and then you have to pay taxes accordingly. Now, in contrast to these pre-tax accounts, there are post-tax accounts. So a Roth IRA, or maybe you have a 401k or a solo 401k if you're a solopreneur and you have a Roth component to your 401k. Your contributions made to those accounts are on a post-tax basis. So you don't get a deduction, but then you have the benefit of tax-free growth. And when you take the money out after the age of 59 and a half, you pay 0% tax. So that amount is not added to your ordinary income. So this is where the potential positive impact could come into play. If you're saving in a Roth account, Roth 401k, Roth IRA, the distributions you take out are not added to your ordinary income. Therefore, there's no change to your tax situation there. Now, keep in mind that your contributions to your Roth IRA or Roth 401k or other Roth account are post-tax. So you don't receive a tax deduction. There's going to be, if you will, no impact to your tax bracket in terms of being able to lower your taxable income. Remember, the benefit of the Roth IRA is the tax-free growth and then the tax-free distributions. So that leads us to the activity of distributions from a retirement account. So starting with the Roth IRA, whatever amount you distribute from the Roth IRA is not added to your taxable income because you already pay taxes on the money going in. In contrast to a Roth IRA, your pre-tax accounts, so your traditional IRA, your pre-tax 401ks, 403bs, thrift savings plans, your SEP IRAs, your simple IRAs, these pre-tax contributed to accounts, because you got a deduction on the money going in, when you distribute money after the age of 59 and a half, the amount you distributed is added to your ordinary income, and then you pay taxes accordingly. So this is where some investors look at being strategic and distributing monies from their pre-tax accounts over many years so that they can spread out their tax burden. This is where you're going to want to do some planning with a CPA or tax professional to determine what's going to make the most sense for you. Now, let's rewind the tape a bit. When we talked about traditional IRA contributions, we mentioned a tax deduction. But there are some instances where when you make a contribution to a traditional IRA, you don't get a tax deduction. This is known as a non-deductible IRA contribution. See, if you or you and your spouse are participating in a workplace retirement account like a 401k, and you are over a certain modified adjusted gross income limit, and you can find those limits on the IRS website, irs.gov, you'll learn that if you are contributing to that 401k at work and then also contributing to a traditional IRA, you may not get a tax deduction for your traditional IRA contribution. It doesn't mean that you can't contribute to the traditional IRA. It just means you're going to make the contribution on a non-deductible basis. They call this a non-deductible IRA contribution. And what happens is the amount that you've contributed that you don't get a tax deduction for, eventually when you take that money out at 59 and a half or older, at that point, you don't pay taxes on that amount. But you're going to have to do the pro rata calculation to determine which amount was growth or earnings in that account versus what amount was a contribution versus what amounts did you actually get a deduction for in years that you were able to get a tax deduction for a traditional IRA contribution. We have a separate video all on non-deductible IRA contributions and those pro rata rules. Okay, so you understand now that distributions in one way, shape, or form will impact you. And between now and the end of 2025, you might want to start taking a look, if you are over the age of 59 and a half, in terms of distributions, how you plan accordingly. All right, lastly, what about Roth conversions? Well, what is a Roth conversion? A Roth conversion, simply put, is where you take money from a pre-tax account, like a traditional IRA or SEP IRA or 401k or simple IRA, and you convert the money into a Roth IRA. You pay the taxes on the seed instead of the crop. Now, when you convert from your pre-tax account to your Roth account, the amount that you convert is added to your ordinary income. So let's say you have $100,000 in taxable income and you convert a $100,000 traditional IRA into a Roth IRA. Now your taxable income is going to be $200,000. $100,000 plus the $100,000 converted amount gives you $200,000 in taxable income. So that's going to impact your tax basis. So you have to keep that in mind. That's inevitably going to bump you up into a higher tax bracket. Now, is that a bad thing? Well, it may not be a bad thing. See, some folks look at it and they say they believe that they're going to be able to drive a rate of return that's substantial enough to warrant paying the taxes now compared to what they would end up having to pay much later on in their life. Now, we can't tell you whether that would be the case for you or not. This is where you're going to want to make sure you talk to your CPA or tax professional, look at what your investment strategies are, and then determine, would it behoove you to convert now compared to paying taxes much later on in your retirement years. Secondarily, important to understand that you can convert over multiple years. You can convert in stages. You can convert as many times as you want throughout the year from your traditional pre-tax account into your Roth IRA. So for example, let's say you're at the end of 2023 or end of 2024, and you convert some money in, let's say, December, and then you convert some more over in, let's say, January. So you've effectively spread your tax burden out over 2 years. And the amount that's added to your taxable income is thus spread over 2 years. So that's where you're going to want to sit down and crunch the numbers and determine what's going to be strategically in your best interest in terms of converting all the money now or converting over multiple years, or possibly not converting at all, depending on your situation. Now, let's go ahead and jump into the tax brackets. So you can see here the 2023 federal income tax brackets. And how does this work? So from a definition perspective, you're going to hear marginal tax rate, and then you're going to hear effective tax rate. So when someone says their marginal tax rate, what they're talking about is which bracket do they fall into. Now, for the purposes of this conversation, let's use the example of an individual that's married filing jointly and makes $100,000 in income. So somebody in that category, they're going to be at the 22% tax bracket. Now, I'll routinely have people in a situation like this say, well, that means that if I make $100,000, I'm paying 22 cents, 22%, or doing the math there, $22,000 in taxes. And that's not the case. See, the way these tax brackets work is on the first 0 to 22,000 in our example, our taxpayer would pay 10% on 22,000, the first $22,000 that they make. Then they would pay 12% on the next 22,000 to 89,450. And then from 89,450 to 100,000, because we're using the example that they make 100,000. So they're going to pay 22% on, that's roughly 11,000 and some change. So they're not paying 22% on their entire 100,000. They're only paying 22% on the difference between 100,000 and 89,450. Again, they're paying 10% on up to 22,000, 12% on 22 to 89,450, so on and so forth. So you have to do the math, the total math, and then come up with what's called an effective tax rate. Effective tax rate meaning the actual percentage of the total amount that you make, in this case, $100,000. Now, in this example, that could be far less than 20% if we do the math there. So our taxpayer making 100,000 is not paying 22% on that entire 100,000 at the federal level. Now, of course, you have to factor in state and local. You have to factor in your Social Security tax, your Medicare tax, so on and so forth. But just looking from a federal income tax bracket perspective, important to understand that. Now, you will see in 2024 that the amounts, so the brackets stay the same, the percentages stay the same, but the amounts have gone up slightly, and that's due to inflation. So the government recognized inflation, and as a result, they have increased these amounts slightly. From an IRA perspective, that's something to keep in mind, because as you're making contributions, as you're taking distributions, again, those amounts, like we talked about, are added to your ordinary income. So you want to run the math and look at what that will look like for you. Now, lastly, let's touch on the Tax Cuts and Jobs Act and how that impacted marginal tax rates and what will occur after 2025 unless there is an extension. So prior to 2018, here's what the tax brackets looked like: 10%, 15%, 25%, 28, 33, 35, and then the top tax rate was 39.6%. In 2018, under the Tax Cuts and Jobs Act, this new tax bracket was created, or this new tax schedule was created. You see 10%, 12, 22, 24, 32, 35, and 37% at the top. Now, unless there is an extension, the Tax Cuts and Jobs Act, as it relates to this, amongst many other things, will sunset after 2025. And so for some folks that are listening to this, they might be in a better situation, they might be in a worse situation, their situation might be about the same. So you want to look at your situation, determine how this could potentially impact you. Now, as it relates to IRA contributions, distributions, particularly Roth conversions, you may want to consider this, because if you end up at a much higher tax rate after 2025, and then you do a conversion in addition to that, you might be in a worse situation compared to if, let's say, you did a conversion now. Now, you have to analyze your individual situation and determine what's going to make the most sense for you. So we really couldn't say that it makes more sense to convert now compared to after 2025. You want to be really careful, because I've seen some articles out there that suggest that. Remember, it's based on your individual situation. I, nor Equity Trust, really, nor anyone other than yourself and your CPA and your financial professionals can determine what's going to make the most sense for your individual situation. So, for example, maybe you plan on retiring January 1 of 2026. And so at that point, maybe you have very low income. So it could potentially make sense to wait and convert then. Or maybe you intend on investing in some unique private assets that generate a significant return, and it still makes sense for you to convert now and pay the taxes on the smaller seed so you don't have to pay it on the much larger crop. So it's really a formula. It's a function of your individual situation, your tax situation now, what your tax situation is going to look like in the future, and then, of course, the return on investment. How much profit are you generating in that retirement account? That's going to be a major variable as well. So I hope you enjoyed this video on the various aspects of IRAs and retirement accounts and the activities that can impact your tax bracket. Until the next video, as always, keep leveraging compounding interest in the absence of taxation.